Look at this recent confrontation, a clash between Senator Elizabeth Warren and Fed Chair Jerome Powell.
Chair Powell, if you hit your projections, do you know how many people who are currently working, going about their lives, will lose their jobs?
I don't have that number in front of me. I will say it's not an intended consequence.
But it is, and it's in your report, and that would be about 2 million people who would lose their jobs, people who are working right now, making their mortgages. So, Chair Powell, if you could speak directly to the 2 million hardworking people who have decent jobs today, who you're planning to get fired over the next year, what would you say to them? How would you explain your view that they need to lose their jobs?
I would explain to people more broadly that inflation is extremely high and it's hurting the working people of this country badly. All of them, not just 2 million of them, but all of them are suffering under high inflation, and we are taking the only measures we have to bring inflation down.
And putting 2 million people out of work is just part of the cost, and they just have to bear it?
Will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
It gets more heated, and I'll play the rest for you soon, but let me give you some context here so that it all makes sense and you know how you fit into this. And this intersects with the recent bank failures we've had. And if you own real estate, what does all this mean to you? Hi, I'm Keith Weinhold, Get Rich Education founder, Forbes Real Estate Council member, and 20-year real estate investor. Well, to quell inflation, the Fed has wanted to raise interest rates until things broke. That's what Elizabeth Warren is trying to get Jerome Powell to stop doing. Well, things broke, and expect more banks to fail soon. See, where Powell screwed up is that a couple years ago, he didn't see high inflation coming, and then when it came, he just said it's transitory, and he still didn't do much of anything. And then once he saw that inflation just kept barreling through and rising, he had to rush to raise rates fast, and now it's really hard to get on top of inflation. And if you think it's not a threat, it is a threat. Look, this is not one isolated event that made a little ripple somewhere. Consider that the bank failures at SVB and Credit Suisse, they were not even related to each other, and you will see more banks fail, and here's why. A couple years ago, interest rates were way lower, so these banks took your deposits and invested them into bonds yielding, say, 2%. Well, now that rates are 5%, no one wants to buy their 2% return bonds, and banks don't know what to do with these things. So banks are sitting on loads of unrealized losses. All right, well, how do you protect yourself? I guess you could buy gold bars or something, but I've got a better way to share with you later. What happened is that a decade of 0% interest in easy money got people drunk with easy gains. Well, now a whopping 8 Fed interest rate increases this past year, they've created a quick sobering up, and it's leaving investors and consumers kind of woozy. We saw crypto exchanges implode last year, and now we've already seen the second and third largest bank failures in all of American history just these past couple weeks, and the government scrambled to block any contagion. The latest inflation reading came in at a still too high 6%. That is 3 times higher than the Fed's 2% target. All right, well, if Jerome Powell and the Fed raise rates, banks break, and it puts upward pressure on unemployment, just like Warren discusses. But if they don't raise rates, inflation could keep running roughshod over America. So if they raise rates, it creates more job layoffs. And why is that? All right, well, that is because businesses, they would have higher borrowing costs. So businesses are less likely to take a loan to expand their business, or say take a loan to invest in some new equipment. That's why that works that way. Oh, and hey, go ahead and put a like on this video if you like how I'm breaking it down for you today. So Jerome Powell's life is becoming more complicated than a Christmas with divorced parents. And until then, for the Fed rate decisions this spring, Overanalyzers, they are tracking Jerome Powell so closely that they might soon try to monitor his sleeping patterns. Goldman Sachs now expects no rate increase at the next Fed meeting and no rate cut either. We'll see. And, it's like the captain has turned on the seatbelt sign because Wall Street investors, those that are in the stock and bond and even the crypto markets, they're going to keep seeing those markets respond turbulently. Stocks, bonds, and crypto, they are highly sensitive to these day-to-day news about adjustments to interest rates and credit availability and news about bank implosions. Well, real estate investors, you're going to have a smoother flight itinerary, and I'll tell you why in just a moment. But let's watch a little more of the confrontation between Warren and Powell. Remember, as you watch this, more Powell rate increases equals more unemployment, and more banks breaking, that's bad, and higher rates slows inflation, that's good.
Let me ask you about what happens if you do this. Since the end of World War II, there have been 12 times in which the unemployment rate has increased by 1 percentage point within 1 year, exactly what you're aiming to do right now. How many of those times did the U.S. economy avoid falling into a recession?
It's not as black and white as very,
Just
very
looking
infrequent.
at the numbers, it actually is pretty black
Alan
and white.
Blinder's written a book on this.
There have been 12 times that we've seen a 1 point increase in the unemployment rate in a year. That's exactly what your Fed report has put out as the projection and the plan based on how you're going to keep raising these interest rates. How many times did the economy fail to fall into a recession after doing that? Out of 12 times.
I think the number is 0.
I think the number is 0. That's exactly right. So then the question becomes, we've got 2 million people out of work. Can you stop it at 2 million people? History suggests that the Fed has a terrible track record of containing modest increases in the unemployment rate. Once the economy starts shedding jobs, it's kind of like a runaway train. It is really hard to stop. In fact, in 11 out of the 12 times that the unemployment rate increased by a full percentage point within 1 year, unemployment went on to rise another full percentage point on top of that. If that's what happens this time, we'd be looking at least 3.5 million people who would lose their jobs. So, Chair Powell, if you reach your goal and 2 million people get laid off by the end of this year, and then, just like in 11 out of 12 times that unemployment has risen by a point in a single year, it keeps on rising. And then we've got 2.5 million people out of work. We've got 3 million people who get laid off. We've got 3.5 million people who get laid off. What's your plan?
Well, right now the unemployment rate is 3.4%, which is the lowest in 54 years. And we actually don't think that we need to see a sharp or enormous increase in unemployment to get inflation under control.
I'm looking at your projections. Do you call laying off 2 million people this year not a sharp increase in unemployment?
I would say 4.5%.
Explain that to the 2 million families who are going to be out of work.
We're not targeting any of that, but I would say even 4.5% unemployment is well better than most of the time for the last 75 years.
In other words, you don't have a plan to stop a runaway train if it occurs. Chair Powell, you are gambling with people's lives, and there's a pile of data showing that price gouging and supply chain kinks and the war in Ukraine are driving up prices. You cling to the idea that there's only one solution: lay off millions of workers. We need a Fed that will fight for families, and if you're not going to lead that charge, we need someone at the Fed who will.
Why would Jerome Powell even want that job after all these years? Ugh. And by the way, Powell became a Fed member after being nominated by President Obama in 2012. He was subsequently elevated to chairman by President Donald Trump, and then he was re-nominated to the chair position by President Biden. Now, I'm not precisely sure why Elizabeth Warren thinks that spreading inflation across everybody is better than job losses by a few. I mean, how exactly do you decide which malady is worse? And hey, what about you? In this confrontation, do you take the side of Elizabeth Warren or Jerome Powell? Which one? Let me know in the comments. Do you think rates should be hiked higher or brought down? Well, with the way that you and I position ourselves as real estate investors, we have a smoother flight itinerary. And that's because unlike stocks and bonds and crypto, real estate prices and rents barely feel the bumps. But you know what? Mortgage rates do, because they are correlated with bonds. Now, bond investing is about as exciting as sitting in middle row seat 36B. You know, just looking at the word bond, it like makes me want to plant my forehead on the airplane tray table in front of me and just take a nap. But explaining bond's importance to you, you know, it's probably like easier than explaining TikTok to my grandparents. Just like real estate, the cheaper you buy, the higher your percent return. All right, well, when there's heightened uncertainty like this, it pushes investors into the safety of bonds, and that demand pushes up bond prices, and bond prices and yields have an inverse relationship. Higher bond prices mean lower bond yields. Mortgage rates track bond yields. So that's why spooked investors who rushed into bonds made their yields fall off a cliff recently, and why mortgage rates fell 0.5% in just a few days. And if you're an active investor, you're wise. You don't keep too much of your money in banks. You need some liquidity, but not too much. Leverage is your long-term wealth builder, and comparatively, compound interest is actually slow. Leverage means debt, and when you have income-producing property, oh, your debt is all outsourced to tenants, and yes, in high inflation, your debt gets debased at the same time. Now that right there, that's perspective that you're not going to get from CNBC. Bank failures will not faze you like they do Wall Street investors. Okay, we build wealth through real estate by strategically borrowing money from banks and not parking money inside banks. Well, if you're interested at all in long-term real estate wealth building, I think you'll find this channel valuable. If you do too, when you subscribe, be sure to hit that little notification bell. That's the only way that you'll be certain to see my next video. I'm Keith Weinhold. Thanks for stopping by.